Chapter 1, Cost Concepts. Hello all, time to start learning some cost concepts. The must-knows from this chapter include 1. Cost terminology. 2. How to calculate product and period costs. 3. How to calculate prime costs and conversion costs. 4. How variable costs and fixed costs react to changes in activity. 5. How to use the cost formula of Y equals A plus BX to determine total costs. And 6. How to prepare both traditional and contribution format income statements. It's important that you realize that there is no chapter more important than this one. All other chapters build on concepts presented in this chapter. Spending time understanding this material will pay big dividends as you move forward. I encourage you to view this video maybe more than once to make sure that you understand what these concepts are all about. Of the videos you'll watch, this video is perhaps the longest. It runs close to 20 minutes. The basic terminology includes the terms cost, cost object, cost driver, and relevant range. The word cost represents a resource sacrifice to achieve an objective. You're spending money to accomplish some objective or goal. The cost object is the something for which cost data is needed. The cost object can include product lines, work processes, employees, customers, jobs, departments, and facilities. A cost driver is the activity base used to assign cost to the cost object. The key aspect of the cost driver is the existence of a direct cause and effect relationship between the quantity of the driver consumed and the amount of the total cost. The relevant range is the range of activity within which assumptions about cost behaviors are valid. As we discuss fixed and variable costs later, you will find that the relevant range defines the limits within which per unit variable costs remain constant and fixed costs are not changeable. Let's assume that we are a company that manufactures bikes. The concept of cost might be applied to the cost of running the building, the wages and salaries of employee, the production equipment, and the materials needed to make a bike. The term cost object is used to identify anything for which we want to get cost data. Examples would be, how much does it cost to operate our administrative offices? How much does it cost to operate our manufacturing facility? How much does it cost to manufacture a bike? The administrative offices, the manufacturing facility, and the bike are the cost objects. The cost drivers would be those activities that cause the cost to be incurred. For manufacturing a bike, the cost drivers could include the labor hours needed for production, assembly, and inspection. Another cost driver could be the machine hours needed to manufacture the bike. The relevant range are the production levels within which our assumptions on costs will be valid. For example, our workers and facility may be able to accommodate the production of 1,000 to 3,000 bikes per month. Anything beyond that may require additional space or more employees. Now let's look at the ways in which we will discuss costs during this class. All costs can be broken into 6 categories. The first category is assignability or traceability. This category consists of direct cost and indirect cost. Direct costs are exactly what they say they are. They are costs that can be easily and conveniently traced to the cost object. The classification of a cost as a direct or indirect cost is dependent on the definition of the cost object. Direct costs include both direct materials and direct labor. In the case of our bicycle, we're talking about the steel frame, the fenders, the spokes, tires, and assembly workers. We refer to these costs as direct because we can look at them and trace them directly to the bicycle. Indirect costs, on the other hand, are costs which are incurred but can't be easily or efficiently traced to the cost object. Indirect costs include indirect materials, indirect labor, and something called overhead. In our bike case, we are talking about the cost of screws, other small materials, welding filler, and glue. Each of these is a part of the production process, but can't be efficiently traced to the bike itself. Indirect costs also include supervisor wages, maintenance and janitorial wages, and costs related to factory operations, like utilities, property taxes, tools, and depreciation of the factory building and equipment. Each of these costs are classified as indirect because they are incurred to support a number of cost objects. Other costs discussed in the assignability category include common costs and traceable costs. Common cost is an indirect cost that is incurred to support a number of cost objects, but again can't be traced to them individually. Common costs are typically include the chief executive officer's salary, the cost of legal services, depreciation and rent on the company's headquarters, those types of costs. Traceable costs, on the other hand, are costs that have a direct cause and effect relationship with a process, a product, a customer, a geographical area, or other cost object. So when it comes to common costs and traceable costs, common costs cannot be traced to a cost object, while traceable costs can be traced. The second cost category is by function. The functional category is useful for the preparation of financial statements. For this category, costs are either classified as product costs or period costs. Now, these two categories are extremely important for you to understand. Product costs are costs involved in acquiring or making a product which will be sold at a later time. These costs have a future benefit for us because at some point we will sell those products to generate revenue. Because they have a future benefit, those costs are always recognized as assets when incurred. These costs are referred to as inventoriable because both merchandising and manufacturing firms record these costs as inventory. As you know from your financial accounting class, inventory is a current asset, which is a line item on the balance sheet. Period costs, on the other hand, are costs necessary to run the business during their normal operations. Because they don't have a future benefit, we expense them with their amounts reported on the company's income statement. In our bike case, all direct and indirect costs related to manufacturing the bikes would be product costs, while all costs needed to sell the bikes, provide general services, and run the administrative operations would be treated as period costs. Look at Apple's income statement. Apple's income statement shows both the cost of goods sold and the operating expenses for a 3-year period. The cost of goods sold are product costs. As such, these costs, when incurred, were treated as assets and part of inventory until they were eventually sold. Once they're sold, they become cost of goods sold, which is an expense to the company. The research and development and SG&A are period costs, which means that they're expensed during the current period because there is no future benefit to them. The third cost category focuses on how costs differ with respect to activity. For this category, costs are classified as either fixed, variable, or mixed. Fixed costs are fixed in total, but will vary on a per unit basis for a particular period of time or range of activity. Variable costs, on the other hand, change with the change of activity. While the variable cost per unit won't change, the total cost will increase or decrease depending on the level of activity, with the total variable cost calculated by multiplying the quantity by the variable cost per unit. Using our bike example, the variable cost would include the cost of all materials, both direct and indirect, needed to manufacture the bikes. The more bikes we make, the more costs we will incur for materials. Also included as variable costs would be the costs associated with the workers who assemble the bikes and the commissions paid to the sales personnel, as costs will increase with more hours worked and more bikes sold. On the other hand, the cost of utilities or property taxes, insurance, and depreciation are fixed, since they'll remain constant regardless of the level of activity. Mixed costs have both fixed and variable components. Examples would include employee wages, which include a base salary plus commissions based on performance, and utility bills, which have a base cost plus a usage fee. Total mixed costs are determined with the formula y equals a plus bx, where y is the total cost, a represents the fixed cost, b represents the variable cost per unit, and x equals the total quantity. It's important again to discuss the concept of relevant range at this point. The relevant range is the range of activity within which assumptions about variable and fixed cost behavior are valid. The relevant range defines the limits within which per unit variable costs remain constant and fixed costs are not changeable. In our bike case, we may have a relevant range of 1,000 to 3,000 bikes, with anything less than 1,000 or more than 3,000 resulting in differing levels of variable or fixed cost. Another type of cost described in the behavior category is the step cost. For step cost, as the anticipated level of activity changes, the level of fixed cost needed to support it may also change once you get beyond the relevant range. Most cost adjustments, upward or downward, will occur in large steps instead of taking place incrementally. The fourth cost category focuses on relevance to the decision-making process. For this category, costs are classified as differential costs, sunk costs, opportunity costs, or out-of-pocket costs. In business and in life, decisions are made because alternatives exist. Differential costs are the cost differences which exist between alternatives. We study those differences carefully to make certain that we make the right choice. Sunk costs are costs which have already been incurred. Because they have already been incurred, sunk costs cannot be avoided or changed regardless of future actions. As such, sunk cost is irrelevant to the decision-making process. Opportunity costs, on the other hand, are costs that measure the benefit that is given up when one alternative is selected over another. The opportunity cost of attending college on a full-time basis is the wage that could have been earned by working a full-time job. Opportunity costs are always relevant to the decision-making process. Out-of-pocket costs are simply costs which require current or future cash outlays. The fifth cost category is based on costs associated with manufacturing companies. For manufacturing firms, costs are separated into manufacturing and non-manufacturing. All manufacturing costs occur in the factory and are related to the production process. All non-manufacturing costs are related to the selling, general, and administrative activities which take place. We refer to selling, general, and administrative activities as SG&A costs. Manufacturing costs include the direct materials, direct labor, and manufacturing overhead needed for production. Direct materials play an integral part for the finished product. All direct materials can be conveniently traced to the final product. Direct labor is the labor cost that can be physically and conveniently traced to the product. Direct labor is sometimes called touch labor. Manufacturing overhead, or MOH, are all costs of manufacturing other than direct material and direct labor. MOH includes indirect material, indirect labor, and all factory operating costs. Manufacturing costs are product costs. As such, they are carried on the balance sheet as part of inventory until the product is sold. At the time of sale, the cost is moved from the balance sheet as inventory to the income statement as part of cost of goods sold, which is an expense. As you know, the cost of goods sold is then subtracted from sales to determine the gross margin. Manufacturing costs can be further broken into categories of prime cost and conversion cost. Prime cost is a sum of all direct material costs and direct labor costs. Prime costs represent the cost needed to get things started in the production process. Conversion cost is the sum of direct labor and manufacturing overhead. Conversion costs represent the cost needed to convert materials from works in process to finished goods. When talking about selling, general, and administrative costs, we usually refer to them as SG&A. All SG&A costs are period costs. They are not included as part of the cost of either a purchased or manufactured product. Instead, as period costs, they are expensed on the income statement at the time they are incurred. The sixth and final cost category deals with controllability. The primary focus is on whether fixed costs are committed or discretionary. Committed fixed costs are fixed costs that have a long planning horizon, generally many years. They usually arise from holding property, plant, and equipment. Typically, once these costs have been incurred, they are locked in for many years. Examples include insurance coverage, real estate taxes, lease payments, and depreciation. Unlike committed fixed costs, discretionary fixed costs are avoidable. These costs represent fixed costs with a shorter planning horizon, usually 1 year. Such costs arise from annual decisions by management to spend on certain items such as advertising, research, and management development. These costs are sometimes referred to as managed fixed costs. The final learning objective for this chapter asks that you be able to prepare income statements using the traditional and the contribution format. As you learned in financial accounting, the income statement provides readers with information on the earnings performance of the company. The statement is always prepared for a period of time, like a month, a quarter, or a year. A net income is reported if the company's revenues exceed the expenses. Likewise, a net loss is reported if the company's revenues are less than the expenses. The income statement, along with the balance sheet and the statement of cash flows, provides the reader with insights on the company's earnings performance, financial strength, risk management, and strength of cash flows. The traditional format income statement presents the results based on function. Sales minus cost of goods sold equals gross margin. Gross margin minus SG&A expenses equals the net operating income or loss. The traditional format, also known as the absorption costing format, is mandated by generally accepted accounting principles and is used for all external reporting. The contribution format is based on cost behaviors instead of function. This presentation subtracts all variable costs from sales to determine the contribution margin. All fixed expenses are subtracted from the contribution margin to determine the net operating income. The contribution format income statement is used internally for decision making. This slide attempts to summarize the concepts which have been presented. Pause the video to see if it makes sense. If not, note those items that are unclear and view the video on that concept again. I'd like to take 5 more minutes to illustrate cost behavior analysis. The schedule on your screen shows how fixed cost is $3,000 regardless of activity levels. It will remain at $3,000 as long as we're operating within our relevant range. When it comes to variable cost, the variable cost per unit remains at $4, while the total variable cost increases as the number of total units increases. The total cost is the sum of the fixed costs plus the variable cost. The average cost columns are determined by dividing the total fixed cost, total variable cost, and total cost by the number of units. Notice how the average variable cost remains the same. It's $4 throughout, while the average fixed cost and the average total cost decrease as the number of units increase. The fixed cost graph illustrates how total fixed costs remain the same regardless of the level of units. The total variable cost graph illustrates how total variable cost increases with each additional unit. If all costs are variable, then at 0 units, there is no cost. Now look at the mixed cost graph. The mixed cost graph shows how variable costs and fixed costs combine to illustrate total cost. The average cost graph illustrates how variable costs per unit remain constant, while average fixed costs and average total costs decrease with each additional unit. Finally, the step cost graph illustrates how fixed costs change with changes in the relevant range. In this example, fixed costs will remain at $40,000 within a relevant range of production of 3,000 to 6,000 units. Anything below or beyond those levels will result in a different level of fixed cost. You'll notice that the change in the fixed cost isn't incremental. It steps up to a higher level. Hopefully these graphs will reinforce your understanding of the concepts discussed earlier in this presentation. Now it's time to apply these concepts to some problem solving. Best way to learn this stuff is through drills. Thanks for watching the video. Good luck.